Hi folks, Chuck Gibson from Financial Perspectives in Pleasanton, California with April 2016's Charts on the Move. We've come a long way from February's lows, and it's normal and natural for stock markets to cool off following such a hot run. This is especially true considering we're in the late stages of a bull market. This vulnerability means we'll need to be especially careful here as the market has become fragile, as this earnings season has been very disappointing. One false step or bad bit of news could kick off a larger wave of selling that pushes us dramatically lower. I'm not saying this will happen, but rather just we need to be aware of those probabilities are increasing. Bull markets should be led by technology, cyclicals, and banks. Cyclicals were down for the month. Technology was the big sector loser, and while the banks had a decent rally, they've stalled. We shouldn't be led by gold, silver, the miners, and materials, but we were. This will be the major theme of this month's video. Market rotation. Before we get into that though, let's take a look at a few charts of the US stock markets. The first chart is that of the S&P 500. And what is hopefully very apparent by my illustrations, we have formed a series of lower highs and lower lows, which is, we all know by now, the most basic definition of a downtrend. In addition, we have negative RSI momentum divergence while the 200-day moving average is flat. You can see, starting on the left-hand side of the chart, what happened the last time negative divergence occurred. Everything about this chart is sending bearish warning signs. Memorize this, as this is what tops can look like and how bear markets start. The next chart is that of the NASDAQ composite. While there are many stocks within the composite from many different sectors, most think of the NASI as a proxy for technology, as that is where the bulk of the stocks in that sector are listed. Like the S&P 500, we formed a series of lower highs and lower lows, while RSI momentum has developed bearish negative divergence and is sporting a flat 200-day moving average. This index is weaker than the S&P as its peaks have become progressively further apart. My next chart is that of IWM, the US small cap stock proxy. As you can see, it looks very similar to the prior two charts with lower highs and lower lows. What is different is the fact that there's no divergence. This is caused because of the much weaker rallies experienced off the lows and a 200-day moving average, which is strongly pointing south. Of the three U.S. indexes, this is by far the weakest. My last chart of the U.S. indexes is that of the Dow Jones Industrials. You can see how this one is different than the prior three. While it's not bullish, it's by no means bearish either, as its most recent high and low slightly exceeded the prior ones, which invalidated the potential for calling a bear market downtrend. This, combined with a rising 200-day moving average, is definitely technically constructive and has our attention. All is not completely healthy though, as we have formed negative RSI momentum divergence, warning of the potential for a period of consolidation or even a correction. So you can see the charts of the US markets are for the most part what I consider to be pretty ugly. But when you include the industrials in the discussion, they're a mixed bag at best. In a bear market, very rarely do any of the big indexes get spared the pain. It's clearly too early to call this a bear market, but without question, we're at a critical juncture forming what may turn out to be an intermediate term top. Remember, tops are rarely an event, but a rather slow and agonizing process. And if this turns out to be one, it's no different, as we have not made significant upward progress for almost 2 years now. During tops, you tend to see rotation from one sector into another. And that's exactly what has been happening, as investors initially ran from biotech and healthcare, then from consumer discretionary stocks, and now technology appears to be in their crosshairs. The money flowed into utilities, and then staples, and then most recently into energy and the 3 M's, metals, mining, and materials. I want to spend the rest of this video looking at a few of those charts. I have spent years honing my process, and what I have found out is that some of the best long-term investment opportunities come from the following simple formula. 1. An investment has to have a good fundamental story and has dropped 50% from its peak value. This is by no means a hard and fast number, as it can clearly be greater or less than 50. 2. It has bottomed and formed a base which has lasted a minimum of 6 months, but I prefer to see 9 months or more. The greater the basing, the better the odds, and the old saying of the greater the base, the higher the space is very true. 3. You want to see that base form a well-organized and recognizable bottoming pattern. 4. You want to see price break out decisively from the pattern and then be confirmed with increased volume. And finally, at some point during the breakout, you want to see the 200-day moving average become positive. With that in mind, let's start with the materials sector ETF. XLB formed a technically beautiful oversold divergent low W bottom. If I could select my favorite setup, this would definitely be it. I find these tend to not only have the greatest chance for success, but also, just as importantly, the potential for an explosive upside. Currently, the 200-day moving average is curled up, RSI momentum is above its midline, and it's rising, and there's plenty of room for further upside. Let's turn our attention over to the precious metals arena, starting with silver, our first portfolio addition. This is textbook technical analysis right here. We had a 9 months consolidation, which formed an inverse head and shoulders bottoming reversal pattern. Notice the big white candles on the break of the neckline, which is indicative of an impulsive move. That's something we definitely want to see. Notice how, too, the breakout was confirmed with increased volume, and the 200-day moving average flattened and is now turning higher. The next chart is GDX, a proxy for precious metals miners, and our second member of our family to be added to your portfolios. It based for just over 6 months before finally breaking out of the W bottom pattern. It moved impulsively higher on large volume, and the 200-day moving average is now comfortably pointing higher. Looking ahead, you can see that we're approaching major resistance with declining volume, so I expect to see a period of significant consolidation or a pullback here soon. If this were to occur, it could present itself as a great opportunity to add additional exposure. The breakout in gold was nowhere as technically compelling as silver's, as you can see in my next chart. It didn't form a base nor a recognizable bottoming pattern. On the flip side, we did see a bit of increased volume with an impulsive move. Because all or most of the above ideal setup boxes were not checked, I have not yet included gold in clients' portfolios. Until we get further positive technical confirmation, such as a breakout of the current bull flag, gold's move still has the potential of being nothing more than a powerful bear market rally. I'm watching closely, as a breakout in gold would go a long way for confirmation that the bear market in precious metals is over. Another signal for verification the precious metals bear is done is to look at the ratio chart of gold to silver. Historically, when precious metals are in a bull market, silver outperforms gold. As you can see in the next chart of that ratio, negative RSI momentum divergence formed at the February peak and also marked the turning point. Notice how, in the past, that same 80 level on the ratio has not only signaled a top was in, but also marked a very good long-term entry point for silver, which is plotted in the bottom pane. To close this out, I wanted to look at one final chart, the precious metals to stock ratio. Just to make sure it's clear what we're looking at, if this ratio is rising, you want to be heavy in precious metals and light in stocks, and just the opposite if the ratio is falling. Using gold and the S&P 500 as my proxies, you can see the ratio recently bottomed with positive RSI momentum divergence and has formed a very nice inverse head and shoulders bottoming reversal pattern. If a bottom is in fact in and we continue higher, this is telling us that the better place for your investment dollar will be precious metals, as they are outperforming stocks on a relative basis. With all this as proof, I can start to breathe a sigh of relief, as it's providing some very encouraging developments. The last 2 years have been really frustrating for me, and I'm guessing you too, as stocks have gone nowhere and virtually everything else was in a downtrend. There's nothing I like more than for my clients to be in the throes of a new bull market in something. In this case, precious metals and materials. Well, that's it for this month. As always, I appreciate your time and your attention, and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with April's Charts on the Move.